Hi, everyone. Thanks so much for joining us today. My name's Laura Shin, and I'm a crypto journalist and host of the Unchained podcast. And I'm here to moderate a discussion between Felix Zulauf, founder of Zulauf Consulting, and Arthur Hayes, co founder and CEO of BitMEX. We're here to discuss events in both macro and crypto, and there's a lot to cover in both of these topics, so we will get right to it. We're wondering, what do you think is the main driver of inflation in Europe and in the US?
Well, the main driver has been too much money chasing not enough goods. And that's the problem. Over the years, we have created a monetary framework that was way too big, too large for our economies. And when there were scarcities popping up in the last year, all of a sudden, the corporate sector found itself in a convenient position to raise prices. And this is how it happened. And then only came the war in Ukraine, where energy prices went up. And then the higher energy prices, they feed into all the services and product prices. And then you get the spiral going on. And this is what happened. When you look at energy, most people think that energy has been the driving force, but the price of crude oil actually today is at the same price as in October in 21, so before the war. And therefore, energy has been one factor, but it's not been the factor driving inflation.
Yeah, and I guess I echo the inflationary construct, and obviously for people in crypto, right? Everybody, at least in the Western world, in the US, got a few checks from the government. Most people that actually didn't need the money, right? It went to mostly people who probably had a job, could work from home, all these sorts of things. And what do? They spent it on GameStop and NFTs and all sorts of stuff. And so that's the stuff that we see, right, in the crypto ecosystem of Bitcoin going from 3,000 to 70,000 in the span of whatever, like a year and a half. So that's one manifestation, and obviously that's reversed quite substantially.
So basically, what Otto says is also we had a tremendous fiscal support, tremendous money being spent by the governments to the consumers, and we had at the same time the lockdown, supply chain disruptions. So we had a push on the demand side up, and we had a constrained supply side, and that created it. And because the monetary framework was already too large, prices could go up.
And at this point, what do you think are some of the ways the Fed could combat inflation, or what do you see the Fed doing?
The Fed cannot increase supply of goods and services. All the Fed can do is it can constrain demand. And that is what the Fed is trying to do, to reduce demand or weaken demand so that demand and supply gets into balance at the lower level of price. That's what they are attempting to do, and I think they will succeed. And once they succeed, they will be shocked how they succeed and what the result is. Because it will lead to a weak economy, of course. It will lead to a weak economy, and then they will be shocked how weak it is, because they should understand that monetary policy works with a time lag of maybe 12 to 18 months. And so what they are doing today will be represented in the economy 12 months out. So at some point in the first half of 23, I think we will see a very weak world economy, and there could be some credit events and problems. And once you see that, the central banks will probably swing around, and that's what the people call the Fed pivot.
And Arthur, what do you think? How do you see the Fed?
I guess I'm also looking for that moment where they things up so bad, like they have to come back to the rescue with printing more money. One thing I haven't actually done enough research on is I forget who it was, posted a great chart of corporate bonds, U.S. corporate non-financial corporate bonds maturing in 2023, and it's $1.6 trillion, something around there, of bonds that are maturing next year. At the same time, you have the Treasury is issuing a record amount of debt because they have to fund the deficit. Because again, politicians need to get elected, and the best way to get elected is hand out free, and they're going to keep handing out free because that works. And so I think coming into next year, we have a record issuance of debt in the US that either needs to be rolled over or is new debt that needs to finance new spending. And what's the 10-year at now, 4% or whatever it is, right? And so if the Fed has to keep raising because inflation is stuck at 7 or 8 or whatever the handle is, and you're at a 5-6% rate, and you came from 0 18 months before, that's a sticker shock. And most businesses and most governments can't handle the change in the price of credit from a 0 to a 5-6 handle at the riskless end of the spectrum. Not to mention when you start adding on credit spread and all sorts of things that makes things more expensive for corporates. So I think next year is going to be quite messy for when some of these corporates have to come to market and understand what a positive interest rate looks like and how that affects their business model and whether or not they're going to be able to continue doing things that they used to do.
Felix, did you want to add?
Well, I just wanted to add that I think next year could be a terrific year for bond investors, at least for a window for 6 months or 9 months or so, because once the economy weakens, then all of a sudden you get the Fed turning from a seller of treasuries into a buyer of treasuries. And all of a sudden you get the banking industry turning from a seller of treasuries to a buyer of treasuries. And then all of a sudden the investors and the speculators come up and they turn from a seller into a buyer of treasuries. So you could have a dramatic swing for a short period of time, for 6 to 9 months, where 10-year treasuries decline by 200 basis points. That is conceivable, particularly if you have that credit event or some other things that really says and signals to the Fed, we have gone too far and we have to change. Once that signal is in, I think you will have a tremendous bond market rally. It won't be sustainable for the reasons that Arthur is saying, that the supply will be tremendous and continue for the years to come. But I think there is an open window for 6 to 9 months for a good trade. And that is quite positive for certain segments in the equity market as well. You know, the equity market would benefit dramatically, and all risk assets actually would benefit dramatically if the long end of the bond market comes down by 150 to 200 basis points. We could have a tremendous rally. So I'm looking for a turn in the first few months of the year in the bond market and in the equity market, and actually I think 23 could be quite good for investors, and that is a guy saying that who has the label to be a pessimist, which I'm not. So I'm looking for an opportunity to turn bullish in the first few months of next year on bonds and on equities, and then also on commodities.
Arthur, I'm curious for your thoughts on.
Well, I mean, I share the same view, and that's the reason why I think, obviously, in the crypto context, everyone's so bearish right now because there's this, every other week there's somebody who's gone bankrupt, who's stolen a bunch of money, right? And it's in the tens, hundreds of billions of dollars, and the destruction of value since probably March of this year. And everyone's like, oh my God, crypto's never going to recover. It's going to take 10 years, blah, blah, blah. Like the institutional investors, like the same things that we hear every single cycle. But I think, to what Felix's point is, a 10-year that goes from 4 to 2%, that's a ridiculously massive move for the biggest market in the world. That will shoot everything up. And I don't care how many scams there are going on in crypto. That sort of move in the bond market is bullish for crypto as well. And the name of the game now is suffer now the boringness, the low volumes. Maybe crypto makes a new low. I don't know if we stay down here at 16,500. But you want to be ready for next year and ready to participate in that rally, because if you blew all your money now, you're going to be very, very sad panda come next year if this comes to pass.
And I actually wanted to circle back to inflation to just ask, because as far as I understand, and correct me if I'm wrong, I believe the supply chains are still kind of screwed up. So I was wondering how that aspect is going to play into all of this and how that will affect I don't know how long this inflation period will go on.
Well, in my view, inflation has peaked for this first mini cycle, and we will see declining inflation next year. First of all, due to the weakening demand in the global economy. Secondly, due to declining commodity prices, including oil prices. You know, the price of oil could go to $50–$60 in summer of 23. Then I think we will get the whiff of deflation out of China. The Chinese economy is as weak as it was in 2008-09 in that crisis. And even if they start supporting the economy and they do something about it, there are structural problems in the economy. I think you will see that the exporters are going to cut prices to just get off the merchandise. And finally, I see that inventories around the world in all three regions, in Asia, in the North America, as well as in Europe, inventories are piling up. And we are accumulating inventories. You see it also in the bank loan statistics, that the bank loan growth is going up to finance involuntary inventories. And I think once the holiday season is over, you will see that the retailers and then the producers want to get off the involuntary inventories they have accumulated, and then you get price cuts. And the price cuts will feed into the CPI as well. So I think you have several factors playing for a declining inflation rate. I do not know to what level, but it could be surprisingly low. All of a sudden, it could be at 3% in summer of next year. And that would be the low point. I think that would then give the Fed and other central banks the feeling that everything is fine and dandy again. And then they will repeat the mistakes they always repeat in every cycle, and they will overdo it again. And then you have another commodity boom coming due to scarcities into 24, 25. And then you have rising inflation rates. And then you have probably inflation rates higher in 24, 25 than you saw this year. It could be double digit in the US. And I don't have to tell investors what that means for their investments. That's the other side of the cycle.
Arthur, what do you think?
I guess the only point to add on sort of the inflation story is, okay, yeah, what happens if China reopens? Does that sort of make production of goods easier, faster? And then again, without government stimulus checks directly going to people's pockets, are they going to be buying all the stuff? Did we just order a bunch of stuff because we thought that there'd be stimulus checks continuously handed out, quarter after quarter in the richest country in the world, in America? Obviously, that's tapered a lot since 2020 and 2021. And then you have to wonder, if they are handing out stimulus checks, is it because, hey, we want people to buy a washing machine, or is it because the price of gas is $10 a gallon? Which is to Felix's point of, okay, the structural underinvestment in energy doesn't sound like it's changing. I think one of my friends told me a story last night about it's somewhere in the Netherlands where they bought up a bunch of farms and closed them because they wanted to lower the carbon footprint. Like, when you're doing dumb shit like that, like you're just setting yourself up for monster inflation in the coming years. And even if the government's printing money, you're not buying a washing machine. You're going to the store and buying milk, butter, eggs, filling up your car with gas. And so we have a different type of inflation, and it's not really the goods that we see piled up in the ports of Los Angeles and Shanghai and whatnot.
And the next rise of inflation from the second half 23 into 25, I think you will also have a geopolitical situation factored in, because the conflict between the two blocs, the autocratic bloc and the democratic bloc, will intensify. And I think this will continue to disrupt supply chains on many goods. And therefore, when you have a deglobalization process, it makes prices go up, and it's inflationary and not deflationary. Globalization was deflationary. That was very good. I think we see the other side of the coin in the years to come.
Yeah, actually, I was going to ask, let's throw in the war in Ukraine into this whole mix. The U.S. Treasury, why do you think they're financing the Ukrainian war? What do you think the economic impacts will be in the U.S. short term and long term? And we can sort of blend it in with all the other trends that you noted.
Arthur, would you like to go first?
Yeah, sure. So I guess the question that I like to ask myself is, let's assume that the Ukraine war stopped today. Would any of the things that are going on in terms of US versus Russia / Eurasian bloc, would they change? Would all of a sudden the West remove the sanctions, give Russians back their money, give all the Russian oligarchs back their stuff that they took, like yachts and whatnot? And if you go through that thought experiment, you're like, well, the rhetoric doesn't sound like, some senior, Western politician is going to backtrack on any of this just because the Ukrainians came to some sort of armistice, right? So all this stuff that we're seeing now in terms of capital controls between the blocks, energy flows, some of that's irreversible, like the Nord Stream pipeline that somebody sabotaged, right? You can't unsabotage it. You're not going to build another pipeline over there, no matter who did it. Are the Russians and the Germans going to come to an agreement to build another pipeline there? Absolutely not. So there you go. Or does Russia focus on, okay, maybe I should build some infrastructure to the east towards China and my partner, supply them with stuff. They're not going to be freezing my money, and we can, exchange goods. So I think, irregardless of when the war stops, the damage has been done. The trust is lost. We're in a new regime, and people need to appreciate that. And the unfortunate part is the war is it doesn't matter who wins it, who loses it, when it stops. Hopefully it doesn't escalate to a nuclear conflict, but it's irrelevant at this point, I think.
Yeah, the most important point is the trust has been battered. There is distrust, and once the war ends, there will be continued distrust. And the trade between the Eastern and the Western bloc will slow down. No question about it. I recently looked at the graph about trade by the US and by China. In what country China or the US is the more important trading partner? And I looked at it in a dynamic structure from 1980 on, when everything was blue for the color of US, and with the exception of China. And then it began to change, and nowadays you have most of the world covered in red for China. So China is the more important trading partner for the vast majority of countries in the world than the US. It's a dramatic change, and we in the Western world do not look at it the right way. We see our Western focused view of the world, but it's probably wrong. The world has changed a lot, and I think it's a big strategic mistake by getting into a conflict with China, because I do not see how the West can come out as a winner out of this. I think we will all lose, and this will be the hardship for the remaining decade, I believe. And it will go up in stages, and it will interfere with our financial markets, and geopolitics becomes much more important than what it used to be. The stock market is apolitical. It's not political, actually. It never paid any great interest to political developments. When you look at it longer term, where there was a political event, it was a 1-2 day or a 1 week affair, and then the stock market didn't care again. I think this time it's different. This time it's a world that is going from a globalized economy to a deglobalized economy that will make the world economy less efficient, more inflationary, and much more difficult to trade for all the individual companies that are participating in global trade. And therefore, I do believe that this has an impact on financial assets. It should mean that we have to raise the risk premium and have lower valuation than it used to be the case.
I actually wanted to mention a few things and ask a question. First was, I saw that Putin made a speech the other day suggesting that there be a blockchain-based settlement system for international transfers and payments. And clearly, I'm sure he's trying to create this alternative to SWIFT. And probably it's because of how Russia had its assets seized due to the war. I was curious for your thoughts on that, but I feel like it sort of is in line with what you were saying about how there could potentially be this divide. And then the other thing that I did want to ask about your China comments was that, when you said that you feel we in the West, have a particular view and we don't see things the way the majority of the world does. Watching these protests in China over the weekend, like people were even calling for democracy and things like that, which is, just a step beyond even, or many steps beyond even just calling for the lockdowns to end. And so I really wondered if this does reflect that, people are kind of more in line with what the Chinese government is doing.
Well, I think people just want to be well off and have to lead a good life and have to have an interesting job and a decent income to support their families and freedom, etc., etc., within a certain framework. And I think there are different systems, and we have to accept that our democratic system is not the only solution to the question. There are others, and we have to accept that other nations want to run their nations in another way. That doesn't mean that I'm a fan of autocratic systems, not at all. I'm for freedom and I'm a Democrat in my nature as a Swiss. Anyway, we have the only country with a direct democracy. But I think the Western world should not try to impose its formula for success to others. Let others do and find their own way to happiness and not try to tell them what they need to do. That's but I don't want to go further than that.
Okay, well, why don't we talk about how this zero COVID policy in China has affected things like, Apple's iPhone production is going to be impacted by this, and obviously that has, much bigger impacts on the economy. And I was curious in general, like how you think these protests will affect the economy globally, and what we'll see come out of that.
I think from my perspective, I think what a lot of people don't understand about China is that the people place a huge premium on social cohesion. So if you look at the history of China over the last few thousand years, it's always about like, what is the Chinese state? It's been invaded from the south, from the west, by different people. It's been ruled by non-Han Chinese for a large period of time, and so the stateless issue of China is a big deal. And so that's why Xi Jinping coming to power and common prosperity and all these tropes that he's rolling out about we're going to overcome the century of humiliation and the unequal treaties and all the things that had happened in China, since probably the first Opium War in the middle of the 19th century. And the people get that. And that's, I think Xi's popularity is a lot higher than people think it is. Many Chinese people are very, very pro-China. If you talk to people who are in business in sort of Hong Kong and Singapore, it's China, 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 rah, 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 we love China. Why is the West being so insolent and demanding that we change the way we want to do things? This is how it's been for the last few thousand years. We have an emperor, he's strong, he's going to lead the rejuvenation of the Chinese people. And so I think that sentiment is there. And while, here and there, a Western outlet might publish some, all the Chinese people want democracy. Okay, maybe a few students do at an elite university like Tsinghua, Beida, or something like that. But the average Chinese person, I think, is fully bought into the system because it's worked for them for the last 50 years. And in terms of like a period of calm and peace, it's been there. So obviously now this zero COVID thing, Xi as essentially the emperor, I think his dilemma is if he opens up, there's going to be a lot of old people who are going to die. And traditionally, if you look back, Chinese history, the mandate from heaven for the emperor rests on making sure that the people are alive, and they can guard against pestilence and these sorts of things. And so he has to tread a very thin line here on how he deals with this. I think one particular way is he could essentially throw the protesters under the bus and say they caused the flare-up of COVID because they came out into the streets, they defied lockdown orders. It wasn't the stupid lockdown policies we had and the ineffective vaccine that we made you take. That's the reason why your grandma and grandpa are dying. It's these bad protesters. And so there's definitely an out for him. It's going to be very tricky though, because again, he can't pull a Tiananmen because there's too many smartphones. But at the same time, he needs to acknowledge that this policy obviously doesn't work, and they're trying in their meandering way to get out of it. But that's kind of how I see the zero COVID protests, and I do think it accelerates the reopening because now there's an excuse to do it, and there's somebody else to blame other than Xi.
I think the vast majority of the Chinese citizens are very happy the way China developed, because when I traveled to China the first time in the late 80s, it was a poor country. I didn't see any cars in the streets. There were only bikes and pedestrians. And they have moved up dramatically. This was a progress that no other country has ever achieved in such a short period of time. So I think the Chinese are very proud about this achievement. Now they have very difficult 10 years ahead of them because they have overdone it. The credit boom, the infrastructure boom was overdone, and they have to digest that, and that will take at least 10 years. And I think the lockdowns that they are using them to not show the structural weakness that is popping up in the Chinese economy. I think they are trying to hide what sort of economic problems they really have in China at the current time, the fallouts of the previous boom, so to speak, and they can justify the weaker economic numbers by the lockdowns and the virus problems, etc., etc. I think this is a message domestically as well as internationally to not show up what the real economic problems are of China. I do believe that the leadership will ease up somewhat due to the protests. I think their response to the protest was very measured, so to speak. I believe that you have to understand that the federal government, the central government, has one level of restrictions, and then there is the province, and the province wants to be a good guy, and they put another level of restrictions on top of it, and then the community puts another level on top of it. I have talked to a guy who has gone to China and had to go to quarantine for 2 weeks for the central government, another 2 weeks for the provincial government, and another 2 weeks for the local government. So he was imprisoned, so to speak, in his hotel room for 6 weeks. And that was not the intention of the central government. That is just how the hierarchy in this system sometimes works, to the detriment of the citizen and the tourist. And I think they are working on that, and they will ease up. And once the flu season is over in March, it will be all gone, I believe.
All right. Well, maybe we can hope for that, and then we'll also see some alleviation of the supply chain issues, and things will get rolling again. I want to circle back actually to some of the issues that we started to discuss around the war in Ukraine and energy issues. And I was curious, if you were to go back and change something about Europe's energy policy, what would you do?
Well, I think that energy policy change, particularly in Germany and also in Switzerland, was very naive. I said so when they decided on it. And you cannot really turn off power plants, nuclear power plants, before you have the alternative ready. That is absolutely naive and it was driven by ideology. And I think the people are beginning to understand that the green movement and the climate apocalyptics are overdoing things, and to the detriment of the citizens. And I think eventually this swing that has gone to an extreme will swing back. And so I think this was the top and the peak of the green climate movement. And I think they will begin to lose attractiveness by many citizens over the next few years. And you will see in forthcoming elections in the European countries where it has been most extreme, maybe even in California someday, that the pendulum will swing back. The pendulum will swing back. So I'm positive. I would certainly not turn off any power plant before the alternative is not there ready. You know, that was nonsense, complete nonsense. And it's because these people in power are not experienced. They have subscribed to a planning economic system, which is really not what we want. And I think it's in a way it's a shock to the average Joe, and he understands that something went completely wrong, and he cannot trust those people in power because they have messed up. And it's not just the current government, it's the previous government that set it all up.
Arthur?
Well, I mean, he has more experience in Europe, he lives there, but I guess the big dichotomy that's interesting in Europe's energy policies, you have France on one hand, I don't know, it's 60 or 70% of all their electricity is nuclear, and then you have the rest of Europe, which is shutting off nuclear reactors. Now, obviously, they're shutting off some reactors in France, but they already are at this high bar of the cheapest source of electricity that you can have, and obviously, it's a lot more secure than hoping that Putin's going to keep sending you gas. And so I know Felix has some views on like the structural, cohesion of the EU, which is a France versus Germany thing. And, the whole point is to keep Germany down. But you see, France has nuclear energy, is preaching all these things about climate change. But at the end of the day, they're the most secure because they actually invested in this ecosystem of nuclear and are reaping the benefits because, their energy prices are nowhere near as chaotic as what you're having to face in the open markets because, the pipelines just aren't shipping the gas anymore.
The bad thing about the French nuclear power plants is that they have only half of them operating, and the other half is in maintenance because it's old, and therefore, on average, I think 150 days per year, they can only operate at about 50 to 60% in the nuclear power plants. This is very bad, but the French are at least building new nuclear plants. So in a few years down the road, they will be ready and they have it. And perhaps even they sell it at an expensive price to the Germans.
So I wanted to ask also about this energy shortage in terms of the rising prices in Europe for energy. How much would you say the shortage is responsible versus the Fed?
Well, there is a shortage, and there is a shortage in electricity, and natural gas, obviously. They have filled up the storage capacities at full, but the storage capacity lasts only a limited period of time, and that differs by country. For instance, in Austria, it lasts for about 8 months. That means they come through winter very well. In Germany, it lasts only 2 months. So if it's not the mild winter, then it's a problem. And then the big problem is next winter, not this winter. I think we will get through this winter relatively well, because everybody is trying to save some energy and electricity, etc. And the problem is next year when you cannot fill up your storage with Russian gas, which you could last summer. And buying all the LNG from USA, that's limited too. So I heard that LNG is sold out until the year 2026. So I think the real problems is next winter, not this winter. So I think the structural problems will stay with us. And if I'm right that the economy will be weak in the first half of 23 and then sort of bottom and trying to recover through 24, then I think you will see energy prices flying very high. So in 24, 25, we could see oil price at $150, $200, and natural gas prices at double the current level, things like that. So this will give us the second wave of inflation, and this will be terrible for the bond market, because we know from experience of the 1970s that the second wave of inflation is the wave that really smashes the bond market. In the first wave of inflation, the market takes it as a temporary thing. When it revives again next time, then the bond market will not look at it as it is temporary, but it will look at it as it is permanent. And that's where the big problem really arrives.
And I guess, like, on the Fed, and I think I've written a fair amount about this. I think the differential in monetary policy when that inflation comes back between the Fed and the ECB, that's how they play into this, right? If you're a local politician and energy prices are rising, what do? You print money and hand out checks. Who finances that? The ECB finances it, because they're buying all of your country bonds. And so if the Fed is hiking rates and the ECB has to essentially print the difference so that people don't revolt, then you have an issue. Obviously the euro collapses and all that sort of thing. And so I think when they've kind of averted that situation now, it got to a bit of a head, probably early in the summer when the euro was, I don't know, 98 cents or whatever it was. But the second time around, if the Fed is again committed to fighting inflation and raising rates into this next inflationary spiral, and the ECB has to print money because they just don't have the energy available. It's not like the US where they have, Canada and Mexico who are, willing partners to hand over energy to the Americans. That's the problem. And that's when you see a lot more, international outcry about, the Fed's high interest rates and their restrictive nature of the economy. We were hearing a lot of that. I think the IMF wrote a letter to the Fed, or whoever it was, all the international organizations saying, stop raising rates. That sort of chatter has sort of died down a bit as the euro's rallied and, dollars weakened a bit. But expect that to come back again if the Fed has to, renew their inflation fighting credentials in the face of inflation, and the ECB has to hand out checks.
The problem for Europe really is that we have a much higher level of energy prices than elsewhere, and I think that will remain the case structurally, and that is a big negative for our industry. And the risk is that a part of Western Europe is going to deindustrialize to some degree, because certain production entities cannot live with the structurally higher price of energy that we have. Not everybody is geared to the spot price, but we have for instance, energy as a percentage of GDP is about 7% in the US. It was 18% in Europe just recently. It's now down to maybe about 16 or 15% or so. Usually 7% is normal. 7% is normal. So we have twice as high energy costs as the US. And that means that for certain industries, it doesn't make sense to produce in Europe. It is not profitable again anymore. And therefore, there is a certain movement from Europe to other places. And that's the big risk, that Europe has messed up to such an extent that we have entered a period of structural deindustrialization and decline in prosperity. That's the big risk for Europe.
I guess I'd add that you could also see the situation where if Russia and China build up the necessary infrastructure, and China continues to advance in the quality of the goods that it produces, you have essentially the biggest commodity producer next door as an ally, shipping you directly everything you need with one of the most advanced manufacturing apparatus of any country. You have the lowest cost goods and the highest quality. And so no more are you going to be buying German stuff or Japanese stuff. You're going to be buying Chinese stuff, and you're going to be happy buying Chinese stuff because not only is it cheaper, but it's the best quality that you can get out there, apart from the American component. And depending on your political leanings, you might not be able to buy the American stuff. So there you go.
All right, we're going to actually pivot a little now just to make sure we touch on a topic that I think a number of audience members are interested in. We've seen the crypto markets reach an all-time high of about 2.6 trillion a year ago. It's now deflated to about 800 billion, or at least as of a few days ago when I wrote this question. And I was curious what you thought were the drawdowns or causes of this drawdown, and how this kind of volatility has made you look at crypto as an investment class.
I'll start with that. I've been through, this is my third bear market that I've done. I've traded crypto longer than I've traded any other asset. So I think this is just par for the course. Bitcoin's down, I don't know, was it 75%, Ether's down 80 or 90%, you know, some things are down 100% or 99.99, but they deserve to be there. And at the end of the day, we have this construct of like, it's, you know, it's a system that is in reaction to too much money printing. And so somebody was able to come up with this technology that lets us send value around the world in a decentralized fashion. But what that means is we are a reaction against the, you know, flagrant money printing of the US dollar system. So the liquidity of the US dollar is extremely important to the equation, right? Because the more money there is out there, the more reason why people are like, oh, okay, a cap 21 million Bitcoin, that makes sense. Or, you know, slightly deflationary or very low inflationary Ethereum makes sense. So when you ramp up credit creation to the largest extent since World War II in the United States from 2020 to mid 2021, obviously you're going to, you know, Bitcoin went from 3,000 to 70,000 in that time frame. And so when you then restrict credit and remove dollar liquidity from the market in the fastest pace since World War II, of course you're going to have the thing, you know, come back down to earth. And the question is, how much higher than where we were when we started this process are we going to be? Is 16,500, which is, what is it, like, you know, 4x, 5x where it was when we started the whole experiment? Is that a reasonable assumption for a bull market in crypto, that we now have a bottom where we can go off to the next level? I think so. You know, I think we're now going to enter the phase of the very boring part of the bear market, which is when Bitcoin is ignored. When, you know, the death of Bitcoin is in every single major financial publication, every single institutional investor that got burned by scams or just the price of their stuff going down 99% just doesn't allocate. They don't talk about it anymore. It's hard to raise money for certain types of projects, and you just get like despondent that nobody's talking about Bitcoin. And then all of a sudden it's going to catch off again. So I think we're in that sort of phase. This is no different. It's a credit crisis. They happen in every single asset class. I don't think this is anything different.
I wouldn't consider myself an expert on cryptocurrencies. I think blockchain technology is a great innovation, that will be very beneficial to the world economy in the future, at the current time and in the future. I do not understand, and I have never understood the intrinsic value of cryptocurrencies. I understood that in a world, in a fiat currency world, where you have unlimited printing of currencies, that when you come up with a new idea of a cryptocurrency that is limited in supply, that's a great attraction. I understood that. But then all of a sudden, after one cryptocurrency, all of a sudden we have now 10,000 or even more of those cryptocurrencies. So I think that is an inflation by itself. And obviously it became the fad of the day. And in every cycle, there is one asset class that really stands out and that gets the attraction of the speculative money. And I think cryptocurrency was that class in the last cycle. And when the system created too much excess liquidity, and you have a bull market in equities, in art, in collectibles, and whatever, you also have it in the cryptocurrency world. And because it was new and it was attracting particularly the younger people, dinosaurs like me had problems with that, of course, but the younger people were attracted, and then it became the fad of the day where everybody thought this is a way to get rich quickly. And once they turned off the excess liquidity, and the macro liquidity in the system began to shrink, then all of a sudden a bear market started. And that was the decline. We were lucky to come up with a sell recommendation around 60,000 for Bitcoin, not because we understood all the details of Bitcoin, but because we saw that the liquidity cycle was changing and that the trend and momentum had peaked, and the sentiment seems to have peaked, and therefore the decline started, and it's now the down cycle, and we are probably in the later stages of this washout. And usually when you have an item that has been the attractiveness of one cycle, in the next cycle it will not attract that much money. Usually you have one cycle where it underperforms, sort of, and does not go back to the highs. Maybe the second cycle after the current one, it could go back to new highs. But that's what I have figured out by reading history books and by looking at cycles in the past. Usually when you have such a big bull market followed by a devastating bear market, it usually takes quite a while to recover. And that doesn't mean that you could have nice moves. I could easily see that Bitcoin could double, 100%. But that brings it to the low 30,000, and we were at 67,000. So percentage-wise, it will be attractive again once the liquidity cycle changes and improves. But I do not believe that we will go back to new highs in the next cycle that starts sometimes early next year, I hope.
All right, so we're going to take this moment to turn to some of the audience submitted questions. And I'm actually going to start with one that we were kind of laughing about before we started recording. And it's a simple 3-word question from someone who appears to work at BitMEX. And it's a nice segue from what we were just talking about. And it's just, when Bitcoin 100K?
When Bitcoin 100K? I would say sometime in like late 23 or late 24. I still think that Bitcoin can regain its all-time high because we've done this before. 80-90% decline, rise back through the level, and you keep going. I think just in every crisis, there's a bunch of people who got burned. They'll swear off Bitcoin, and the rally was going to be under-owned for a long period of time. Bitcoin might be at 30,000, 40,000, 50,000, 60,000, and nobody's writing about it because all the people who got bought the top are just licking their wounds. Like, why would I ever trade this thing again? And so the question is, where does the supply come from? And obviously you have the halving in there, which is the reduction in the forced selling by miners who need to repay their capex and energy costs. That also is a factor in why these bull markets are usually so explosive after the massive washout. And the reason why I'm confident that we're nearing the bottom is because if you look at sort of the types of firms that have gone bankrupt now. So let's take, Alameda, FTX, that debacle, right? You would assume that these guys would have a lot of Bitcoin, a lot of ETH, a lot of the benchmark cryptos. Zero. I mean, that's why they went bankrupt. They have nothing. They have Serum, Dog, Samcoin, and FTT tokens, right? But they don't have Bitcoin. They don't have Ether. So like, if this is one of the most irresponsibly long counterparties in the whole ecosystem, and when they go bankrupt, they have no Bitcoin, which basically means they sold it all to try to stay afloat so that their illiquid pieces could somehow survive. That tells me that we're near the liquidation phase of the real cryptos, the Bitcoins, the ETHs, some of the other ones that actually have some real technological merit. Okay, maybe XYZ, Bitcoin that's like number 500 on the list could still go down another 90%, but that's not really what I'm looking at and what I consider the start of the next cycle. You're going to have to see Bitcoin start outperforming before you start getting into all the funny stuff. So yeah, late 23, early 24.
Wow, that's amazing, because right now Bitcoin's at roughly 16,400. So Felix, I recognize you may not have a projection for when Bitcoin will reach 100K. If you do, you can share it. But also go ahead.
I would say August 1st, 2029. I mean, it's a silly question. It's a silly question and it's a silly answer because nobody can know. The important thing is to know when the pendulum swings from bearish to bullish. And I do believe that in the next few months, we will see that. We are very close to the bottom. We are in the later stages of the bear market. Maybe one more washout in equities and holding up in the crypto world would do it. So I think by the end of the first quarter, we have seen the lows, and then we go up again, and then we'll see what it will bring. And whether it will go to 100,000 or not, I leave that to those who are experts. I'm not.
Well, so this is actually the perfect jumping off point to another audience question, which is, what do you think is the most investable asset right now?
12-month U.S. Treasury. I love them. Can't get enough. 4.7%, and I get roll down. I love that. And then when the cycle shifts, they're going to rally, and you get out and you do what you want to do. I love short-term Treasuries. That's my
but wait,
asset of choice.
If you're saying that you think that Bitcoin might be at 100K in roughly a year, then wouldn't it be that?
Well, no, actually not, because again, what Felix said, right? You want to be earning money while you're waiting for that shift to happen. If the stars align and we believe equity is going to wash out and the Fed's going to have this moment, right? The moment of 2020 resulted in Bitcoin going down 50% on that day, right? So just because you were in at 7,000 and it went to 70, you were in at 7,000 and went to 3,500, then it went to 70. Most traders can't survive that. They don't have the mental capacity to do it. They probably size their position wrong. And so if you're waiting for that moment, you probably don't want to be in Bitcoin, because it's going to, correlation one, everything's going to go down at the same time. And anyone who had too much leverage is going to get wrecked, even at these levels. And so, it gets paid. I'll just get paid to wait. I'll sit in treasuries. And then when that situation arrives, I'm ready to go.
Okay, Felix?
I think we are at that interesting point of time in the cycle where you can really move from one asset class to the other over the next 6 months. So at present, I would still be in cash. 2-3 months out, I would be in treasury bonds, 30 years. And in 4 months, let's say, I would then jump to equities, and particularly growth stocks. And the beaten down darlings, the Microsofts and the Googles and all those kind of stocks, because if I'm right on the bonds, then I think these stocks that have been selling badly down badly over the last 12 months will jump back quite dramatically, because this will not be the next big bull market, but I think the first move up in the next cycle will be dominated by the growth stocks. And that's the Nifty 10 of the NASDAQ 100, the 10 largest stocks you can buy. And then I would move to commodities, because I think commodities will then carry on into probably 2025, whereas the growth stocks will fade by late 23. Then it's over together with the bond market. So it's a step-by-step process, and I hope I can getting the message across to our subscribers as the time is right for this or that asset class.
All right, there's a couple other questions we'll try to get to in the few remaining minutes. This also came from BitMEX, and this person says, where's the liquidity? When will it appear?
The liquidity will appear as soon as the economy is bad. As soon as the economy is bad, or you have a credit event, then you get the swing around in the Fed policy, and then they will print a lot of money and inject it into the system, and the real economy cannot take it, and then you have excess liquidity, and that liquidity flows into the financial assets. And then you have the beginning of a next bull market. So I think you will see it in the first 6 months of next year, that process that I just described.
And then, I don't know, to add to that, maybe we see some things with the reverse repo. I can't predict where it's going to go, whether it's going up or down, but that $2 trillion is just sitting there. That can determine a lot of things. And that's purely a policy choice of the Fed and the Treasury on how they want to adjust the markets to either make that cash appear into the general system or keep it in these facilities that they've created.
Arthur, this question is specifically for you, and it says to ask that I should ask you what your favorite little-known crypto projects are, By the way, I don't think anything he's going to say is like investment advice, but
Okay, and to be clear, I own these. I own a lot of them. My number one favorite thing is looks rare. I believe that NFTs are the tradability of human culture, and therefore I want to own a platform that's paying me every time somebody wants to trade one of these. So that's looks rare. Number two is GMX. It's the second largest derivatives platform that's a decentralized exchange, and it pays all its revenue out to its token holders. And they do, I don't know, 200 to $500 million a day in ADV, and they charge a fee. So I love those projects. They're both, sub $500 million fully diluted market cap projects, and they pay yields of 15 to 40% in ETH every day. So that's what I love.
all right. So we're going to end on a question. Let's see, there's multiple. I'm trying to decide. Okay, we'll take this one from Lisa. Do you have a feel for a triggering event for the final leg down in equities, or do you believe it primarily will be the margin squeeze from price reductions due to excess inventories?
I think you will see both. You will see probably some sort of credit event. I cannot tell you where and who it will be, but usually in the late cycle stage, you get some sort of a credit event. And I also believe that you get lower inflation by cutting prices when the retail sector in particular wants to get rid of stuff, and then you get both. I think all the factors that I look at will play into the hands of a Fed pivot, but not now, but in the early, let's say, 4 to 5 months of the next year.
All right. Well, I think we're basically at time. It's probably a little bit too tight to try to fit in one last question, but are there any parting thoughts you would like to leave?
Be judicious in the amount of leverage that you use in these very volatile times.
It's important as an investor. It's important how you behave at the top and at the bottom. And you have to sell at the top and you have to buy around the bottom. And everything in between is secondary. That's noise, short-term noise. And I think that most investors focus too much on the short-term noise than on the big picture. We try to help them to focus on the big picture.
All right. Perfect. Great parting words. Well, thank you everyone for attending. This was a fabulous discussion, and yeah, it was great seeing you all.
Thank you.
Thank you very much. Thank you. Thank you, Laura. Thank you, Arthur.
Thanks, Felix. Thanks, Laura.
Thanks.